concept now to understand. Now, when talk about deferred tax, this is actually defined under IAS 12 as an accounting device which is now used to measure the tax effect of a transaction with what referred as the accounting impact. Or in very simple terms, when talk about deferred tax, we can say that this is the amount of tax which was supposed to be paid in the current financial year, but it has been deferred and it will be paid on a later period, or it is an amount of tax which an entity or a company was supposed to recover in the current financial year, but it has been deferred and it will be recovered in the future. So therefore, in very simple terms, that is what referred as a deferred tax. But in terms of how this is defined under IAS 12, we have said it is an accounting device, used to match the tax effect of a transaction, with its accounting impact, Now, in this case, what you need to note is that a deferred tax will arise as a result of the difference between what we refer as accounting profit and what we refer as a taxable profit. And even before we look on how deferred tax arises, I want us to differentiate between those two profits, that is what we refer as accounting profit and the taxable profit. Now, when talk about the accounting profit, this is what in other terms we refer to as the profit before tax, and this is a profit which is computed in terms of preparing the income statement, of which now for us to compute this profit here, we computed based on the various accounting policies and also the various accounting concepts adopted by an entity. So therefore we say that the accounting profit is the profit which is computed, or a profit which is based on the accounting concept and policies adopted by an entity, And what that means is that whenever now we are to compute now this particular profit here, that is the accounting profit, we take all the incomes of a business and then we less all expenses, meaning that the incomes now which we take into account, they may be taxable incomes or may not be taxable incomes. Still we less all expenses which may be allowable and which may be desirable. So that profit which now is reported by an entity after preparing the income statement, we refer to that as accounting profit. So therefore we do have those as basically the various formulas which we use in terms of computing now the free cash flow to equity